in that little bit of an up move. Rupen Rajguru, head of equity investment and strategy at Julius Baer, is now joining in on the show. Rupen, thank you very much for joining in. How do you feel about the market and what is it that you're doing?
Hi, afternoon, Rima. So we are at an all-time high levels of market. Everybody is happy, so are we. And the Indian market and US market probably has been two markets which have been on a roll. And while everything looks to be pretty good, we are very good from a economic cycle perspective, but clearly on the valuation cycle perspective, we are at a higher end of valuation. So times like these, we have seen historically in the worst of mistakes, people do tend to make in best of times. So in this market, our objective is to ensure that we don't commit mistakes, because in the urge to get that extra additional alpha, I think a lot of people do tend to land up doing a lot of mistakes in times like these. So our objective is, even if we make lesser returns from here, it's good, but we should not be making mistakes. So a little bit of defensive portfolio tilt is what we are advising.
Okay, hi Rupen, good afternoon. Let's talk about what you like then. And I like your contra strategies. And this time on the list, I believe, is insurance. That actually, if you look at it in the last 3-year time horizon, it's been a relative underperformer. So your view on insurance and what you're like from there, point number one. Point number two is chemicals. We spoke to the management of Vinati Organics and they are guiding for better times ahead. Even various other companies, I was going through the con call notes and everyone's saying we have put on capex, things are turning around. Second half of this year will be better and FY26 will be even better. What's your view on both these two sectors?
Yeah, hi, afternoon, Nigel. So, just taking ahead from the earlier point, since we are in a bull market, so essentially at the current market juncture, our view is, the theme would be consolidation and rotation. So that is purely from a market perspective. So we would like the market to consolidate at current level of 25 or 1,000 levels for some time. But since we are in a bull market, there will be constant rotation. And we have seen it, right? Like a classic example is IT. In last 2 months, we have seen IT index giving almost 20% returns. So with that perspective, what we are looking through, which are the sectors which are probably relatively unloved by the market. And if one or two catalysts come into play, it can really give high returns. So insurance and chemicals definitely fits into the bill. So within insurance, if you see while in last 2-3 months, the stocks have done well, but as you rightly said, in last 3 years, lot of be it the life insurance company or be it some of the health insurance company, both have been a big relative underperformers. And there were a lot of issues, regulatory headwinds were there, taxation impact, and all other things. And the entire insurance sectors have been through the cycle. So as we stand ahead, the macro story of insurance has not gone away, right? Because 3 years back when the entire life insurance companies were in a bull run, what was the story? The story was of penetration, story was of how much potential is there in India. So that remains definitely. So now majority of the regulatory headwinds are behind us. A lot of companies have expanded their distribution network. They have looked into various channels. So we like life insurance as a space. So within that, we like companies which have a very good banca insurance partnership and which has a wide range of product suites. So some of the top 2 companies, they are good fit into that bill. We also like the the health insurance space, because that space also, we believe the price hikes have been done, and over the next 2 to 3 years, we will definitely see the earnings coming through, because the overall combined ratio will be closer to 100, and that will lead to a good growth in the overall ROEs for that. So that's the space on the insurance side. On the chemical side, again, it's a classic cyclical move. Between 2017 and 22, it had a phenomenal bull run. The chemical index compounded more than 40% and outperforming the Nifty. And thereafter, for last 2.5 years, a lot of them have done nothing, and some of them have corrected also from their all-time highs. So all the in bull market, in cyclical, all the mistakes, capacity expansions and all have happened. And plus, what we are seeing in the cycle, a lot of destocking was happening, which is probably now going to end. The prices of the end products are stabilizing. The input cost, which had gone up, is also now coming off. So probably end of the year, we will see the earnings cycle coming through. So probably, we are, 6 months ahead, but that's how you play in the market. And hence, that is another sector which we believe can be a good play in the current market environment where everything looks to be pretty expensive.
What about QSRs? You're taking a contra bet on QSR, but so far, at least in the earnings, it's not that we've seen any green shoots about a recovery in demand.
Yeah. So Rima, it always, some of these things do tend to have mini cycles, which, at times it's very difficult for us to comprehend why it's happening, right? And in fact, if I were to extend, some of the plays which are to some extent linked to the rural recovery as well. So while QSR is not strictly rural recovery play, but a play on the consumption side. So be it the QSRs, be it the some of the footwear companies, or be it the movie exhibition companies, all have been having a pretty lull patch for last 6 to 8 months. And what we are seeing incrementally now, the demand will come back, and I think the overall two things. One is the rural recovery, and also the overall wealth effect will be there. So we don't see a challenge. There was always, over longer period of cycle, if you take historically, QSRs also in a high inflationary environment do tend to, their SSG do tend to get impacted. And now with inflation also getting under control, we believe again, market looks into the relative rate of change, right? So when a lot of them had a 4 or 5 bad quarters, so now the base is a good base, and incrementally on a relative rate of change, a lot of these things will look to be pretty decent, and hence market will also take notice of that and accordingly reward. So we believe that the rate of change is what one should look into, and in all these segments, the rate of change from here on will be pretty good.
Okay. Rupen, great to have you on. So, another pocket of the market where obviously there is some valuation comfort, but the issue is how much patience do you need to have is obviously the entire financials landscape. And even here, some of the, for instance, capital market related plays, they've started doing a lot better. Insurance stocks have got a nice leg up in the last few weeks. But the big banks, they still remain very range bound. What is your approach to financials? What are you picking here? What are you avoiding?
Yeah. Hi, afternoon, Surbhi. So there are two ways to look at it. One is financials as a pack historically was a significant overweight in all the FPI portfolio. Almost they were like 200 to 400 basis point higher weightage they were having. So when there was this FPI selling which came through, so a lot of the technical selling happened in large, and their exposure was predominantly large private sector banks, and they got impacted. And a lot of the managers, what did they do? They didn't want to increase their exposure towards financials because it was the highest weightage. So they did some bit of reshuffling, and hence maintaining the BFSI weight, a lot of the weights from private sector went into insurance, some capital market plays, some of the other plays, and hence, the other segment did well. And coming now to financials, and there I would break it up into two parts, which is the large private sector bank and the public sector enterprise, public sector banks. Probably from a fund management industry perspective, it is consensus a trade, and which has not worked so far there, which is large private sector bank. We are also from the camp wherein we believe that in current market juncture, the relative margin of safety in large private sector bank is pretty high, because they all are, I would say, call them derated growth. So while growth is coming through, but the stocks have not done well, meaning they have got derated. So from 4 times book to 3 times book to 2 times book. So now we believe that we are finding kind of a bottom to the valuation of these plays. And in the credit cycle, while the credit growth is a little bit lower, but if the overall credit cycle more from the non-performing assets perspective comes through, these guys are relatively better placed than public sector enterprise, and hence that valuation differential, which had kind of converged, again will start diverging when the real, when the credit cost goes higher. We will clearly see the private sector bank coming back to reckoning, and we believe this is the year in which we will start looking into that. So we are positive on the large private sector banks within the financials.
Okay, all right. Rupen, appreciate you joining in. Give us a view on the market.